Greetings and welcome to Goodwill, Nature, Transfer, and Remedies. Hang on a second. What's going on here? Oh, there we go. Nature, Transfer, and Remedies. This is condensed from American jurisprudence, and we're going to get right into it. But first, just to remind everyone, this is strictly for the entertainment and educational purposes of this YouTube channel and broadcast, not to be used, abused, or misconstrued for anything legal, lawful, personal, public, private, business, financial, tax, or otherwise. So please don't do this at home. That said, welcome and greetings to everyone. Just one moment here and get everything set up here technically for the chat. And let's get started. So we're going over the American jurisprudence on goodwill. And as we went over before with property, that goodwill is considered an intangible property. So let's see exactly how that jibes with the American jurisprudence as we study it through this presentation here. We're going to go over, in general, goodwill. We'll also go over the transfer of goodwill, since it is property, and remedies for trespass or other violations. So let's go over this comprehensive examination. And here's our overview here. I'm not even going to read all this because we got a lot to cover. Let's get through it. And for this one, at the
ROB 5549 says Lux Benhead.
Excellent, and thank you. And thank you for the membership too. Greetings to all, and welcome to the membership. So we will be getting into the general overview of goodwill, transfer of goodwill, and the rules applying, and general remedies too, the principles, things like injunctions and the damages that come with the remedies for violations of goodwill. So section 1 goes over what is goodwill. At its core, goodwill is an amorphous concept. So nothing as crystalline as it's changed, it flows, amorphous concept. The positive reputation that a particular business enjoys, manifested as an expectancy of continued patronage from its customers. So that's what goodwill is. At its core, it's an amorphous concept. It's the positive reputation. So this is not negative reputation. This is only a positive reputation that a particular business enjoys, manifested as an expectancy of continued patronage from its customers. So the nature of the expectancy arises from the relationships, reputation, and circumstances a business has accumulated over time. It is the advantage an established enterprise has over a new entrant, and it is precisely that advantage that the law recognizes as property. So, interesting here. You would think that this type of property is recognized as an advantage. And the form of property this would be considered would be something along the lines of intellectual property or social capital, as it may be. It's built on relationships and reputation. Let's continue. Let's look at the sources of goodwill also from section 1. The goodwill may arise from any of several recognized sources. Two of the most fundamental are established customer relationships, the habitual return of customers, the probability that old customers will resort to the old place. It is the most classic expression of goodwill. It is the accumulated loyalty of a business's patronage, built through consistent conduct over time. Courts have cited this as the traditional definition of goodwill. Now, I might add here that you could extend this beyond just established customer relationships, but also established vendor relationships. Because when you consider a habitual return, you can just replace the word vendors with customers, because if you're suppliers or you're vendors for a business, you have good relationships with those suppliers. Perhaps you can get goods for a lesser cost, which gives you a better advantage in the marketplace. So in essence, a good relationships, positive relationships and reputation with your suppliers could also be considered a source of goodwill. But that's just my interjection here. That's not from the text. But as I read it here, it seems that it would be good reason for that to apply through this logic here. But again, we're looking at the traditional definition, so this would be something more novel. Then the location. The physical location of a business is a primary element of its goodwill and a saleable component. Indeed, there's better locations for people to return to. Importantly, location-based goodwill survives the death of the professional occupying the premises. It attaches to the place, not the person. Wow. So as we see here, this is an element here where it's not attached to the person or the business, it's to the location of the business. And we'll dig a little deeper and see where that severance might occur when we get into transfer. So there's three further recognized sources. So the name and reputation, continuity of a commercial name and a favorable reputation for skill, affluence, or punctuality are recognized sources. The business name itself can carry and transfer the accumulated value of that reputation. So the business name can carry and transfer. So when you sell the business, it can transfer that accumulated value of reputation, a reputation for skill, affluence, or punctuality. Then, I guess I alluded to this earlier, the advantageous business relationships, favored relationships with employees, suppliers, financiers, or others whose goodwill toward the business has a positive commercial impact are recognized elements of the concept. And the ancient partialities, courts recognize the intangible pull of ancient partialities and prejudices, the simple fact that people return to what is familiar. Wow, so courts recognize the ancient prejudices and goodwill. That's an interesting one to see there. All right, let's look at some of the cases here then. We have the BAA PLC versus Acacia Mutual Life Insurance Company. Goodwill is the advantage or benefit which is acquired by an establishment beyond the mere value of capital, stock, funds, or property employed therein. In consequence of the general public patronage and encouragement which it receives from constant or habitual customers on account of its local position or common celebrity or reputation for skill or affluence or punctuality or other form of accidental circumstances or necessities, or even from ancient partialities or prejudices. So there it is, the goodwill. And a commentary is this: the BAA offers the most expansive judicial definition in the canon. It deliberately captures the breadth of factors courts will consider, from the quantifiable, location, punctuality, to the psychological, ancient partialities and prejudices. The definition is inclusive, reflecting the amorphous nature of goodwill as a legal concept. So, capturing that amorphous concept in the text here makes it a very prominent case. And BAA versus Acacia Mutual Life. And another case here is the Scraback versus Scraback. So the traditional definition of goodwill is the probability that old customers will resort to the old place. And that's, let's see here, where the BAA is expansive, the Scraback is lapidary, a single clause that has become the standard shorthand for the concept of goodwill. Its elegance lies in what it captures. Goodwill is not about what the business has done, but what about it can expect from the future to hold. Wow, now that's a concept. Past performance is no predictor of future returns. It is forward-looking, probabilistic, and rooted in the specific relationship between the enterprise and its established customer base. Rooted in the specific relationship between the enterprise and the customers. Together, BAA and SCRABAC bracket the legal definition. BAA tells us where goodwill comes from. SCRABAC tells us what it fundamentally is, the expectancy of continued patronage. So this is very good here. BAA shows a source. SCRABAC tells us the fundamental expectancy in the future. And some more, we have competitive advantage defined here. The goodwill of a business may be defined as the advantage of a business has over its competitors as a result of its having been carried on by a particular person for a period of time. And that's in Ray Fitch in the Bankruptcy Southern District of Illinois, 1994. So this is an interesting one here. The goodwill of a business may be defined as the advantage. So adding value to the business name here. Having been carried on by a particular person, though. Interesting. So perhaps it wasn't attached to just the name. And then we have this case here of goodwill is an advantage or benefit acquired by a business beyond the mere value of its capital, stock, funds, or property employed. And that's Gilmore Ford Incorporated versus Turner. And that's Alabama, 1992. So in Ray Finch and in the Gilmore Ford share a useful emphasis. Goodwill is fundamentally competitive advantage. The premium the market attaches to a business with a track record. Both underscore that goodwill is measured as value above and beyond the physical assets. And Ray Fitch further holds, under Illinois law, that goodwill cannot be separated from the tangible assets of a business and exists only as an incident of a going enterprise. So once the enterprise ceases, and it seems like that's Fitch, that's the bankruptcy one. So it seems like if they dissolve the company here, that the goodwill value, it seems like it would be set. It cannot be separated here. It's no longer a going enterprise if it ceases to function, and it's separated from the tangible assets. I'm sorry, it cannot be separated from the tangible assets. All right, some pretty heavy cases there, but then we have Section 2, going concern value distinguished. Oh, okay. So while goodwill and going concern value are often spoken of together, the two are technically distinct. The difference that matters in valuation, dissolution, and tax proceedings. So goodwill represents a pre-existing relationship arising from a continuous course of business. It is the expectancy built up over time that the customer base will continue to patronize the business. Goodwill is one ingredient that makes a business worth more as a going concern. So goodwill is the one ingredient that makes a business worth more as a going concern. Then there's the going concern value. Going concern value refers to the ability of a business to generate income without interruption, even after a change in ownership. Okay. It is the broader measure of business continuity encompassing all elements of the business as an active enterprise. So both the tangible assets, I guess you'd even say the human resources, right? But the goodwill is one ingredient that makes the business worth more as a going concern. So it's one thing that adds to this. So the key relationship is goodwill is a component, not a synonym, of going concern value. It is one ingredient that makes a business worth more as a going concern than as a mere collection of physical assets. So instead of just measuring the equipment, the cars, whatever, the building value, the physical assets, we're looking at the business worth more as a going concern. As one ingredient is goodwill. All right. Future earnings, Section 3. Goodwill and future earnings are related, but analytically distinct valuation concepts. Conflating them leads to error in business dissolution, equitable distribution, and damages proceedings. So we're already into kind of some of the remedies here, but You can look at this here, how the goodwill valuation, the value of goodwill, is the present value of the expectation of future patronage. What a willing buyer would pay today for the established customer relationships the business already enjoys. So, what is someone willing to pay today for a recognized business as opposed to some fly by night for all they know, right? There's an added value there. So that's the valuation. What's that difference? And the future earnings valuation. Future earnings projects total revenue or profit streams forward without isolating the patronage component. It does not focus on the present value of expected public patronage as a distinct element. So the practical implication is like in a marital dissolution, both future earnings capacity and business goodwill may be assets subject to equitable distribution, but they must be valued and treated separately to avoid double counting. Ooh.
Matter 5011 says so blue chip cash cow or corollaries of an entity with goodwill.
I don't know. I'm not sure if they're corollaries of an entity with goodwill. Blue chip, perhaps, in a way, I guess. But these are, I don't know if that would be necessarily goodwill. It would be, I guess, if they could claim to that. Again, is that's being rated as something like that? How you bring that in is evidence and not just hearsay. So there still has to be some type of substantial evidence with the business itself. In addition to that, that would definitely be something supporting, I believe. But we get again here, we're looking at the essence of it here. Um, there's a way of quantifying it and a way of psychologically valuing it. And these are things that need to be established particular for the business, not just a rating from a third party. But it would give guidance for that, and it definitely would support any evidence. So yeah, good call on that. Let's go over section 4, the nature of goodwill as intangible property, which brings us bridges over to the ones we are doing on property in American jurisprudence. Goodwill is intangible property, and unless too uncertain or contingent to be appraised, it constitutes a valuable asset of the business of which it is part. So if it's uncertain or contingent on something else to make it more uncertain or variable, then as long as that's not happening, as long as it's not uncertain or reliant upon something else, it can be appraised as a valuable asset of the business. So let's look at the indefinite duration and self-regenerating. Now think of it as an asset here. An asset regenerating and an asset with an indefinite duration. Now, indefinite's not infinite. Indefinite is just saying there's no defined endpoint. It doesn't mean it can't end. It just means we don't know if or when it will end. Goodwill is presumed to have a useful life of indefinite duration. It has no fixed expiration. It is also self-regenerating. Its economic value fluctuates with the fortunes of the business, but does not automatically diminish over time. These characteristics distinguish it from a depreciable asset. So there's no depreciation baked into a time factor for goodwill, but it can fluctuate with the fortunes of the business. All right. Then when there's a surplus value, goodwill is measured by the value of the business over and above the value of its physical property. So it's a surplus value, the premium the market attaches to an established ongoing enterprise. So you'll pay more from a burger from McDonald's than you would from McDowell's. This surplus value measure is the practical starting point for any goodwill appraisal. Begin with what a willing buyer would pay for the entire business, subtract the value of identifiable, tangible, and intangible assets, and the remainder is goodwill. So that's interesting there, the subtractive approach to finding out the value of goodwill. All right, let's look at the limitations. Goodwill operates within important legal limits. Two are of immediate practical significance. One is, as we saw here, the going concern is required. Goodwill cannot exist where the business is not a going concern. Under Illinois law, for example, goodwill cannot be separated from the tangible assets of a business. It exists only as an incident of an active enterprise. A dormant or dissolved business has no goodwill to sell. That's a good expression. And there's no automatic attachment to real property. Goodwill does not automatically attach to the real property where the business is conducted. So we saw about location, but it's not just the real
Matter
property.
5011 says, can you tie accounts receivable into this like GOP, as in an entity can obscure a loss of goodwill by valuing accounts receivable as an asset rather than a liability?
Indeed, there would be some aspects of bookkeeping where goodwill is valued in there. And as we're seeing here, it's valued in both the quantitative and the psychological ways. And then the creative bookkeepers are going to figure the best way to have that in their books. But that gets a little bit complicated there, and that would be specific to the application, but good call on that one as well, because in essence, this is all about trying to value something that's of business interest. So if it needs to be liquidated, sold, what have you, dissolved, that you have actual values so that the courts can handle it. Because without value, I mean, aside from the injunctions, which we'll be getting into also, it's looking for a value to be able to come up with a remedy. This is primarily about business. The goodwill is about business. So this is where we want to look at it from a valuation standpoint. Indeed, the bookkeepers are very much aware of this, and I'm sure it's used in very many ways of profit and loss too.
Matter 5011 says, like the USD being shits in 71.
well, we digress. Let's move along here. So again, there's no attachment to real property of goodwill, even though it is by location of the business, but it's where the business is conducted follows the business, not the land. So goodwill does not automatically attach to the real property. The goodwill follows the business, not the land. A purchaser of the real estate does not thereby acquire the goodwill unless the business itself is transferred. The two assets are legally distinct. So the two assets, so if you sold the business in its location, then there would be no issue. But if you moved the business away from the location, some of the goodwill was established by the location, well, then they need to be assessed by different legal distinctions. So there's an important aspect right there, evaluation when it comes to moving a business and the goodwill attached. Two further limitations, one concerning leasehold value, and the other the scope of legal protection. So independence from leasehold. Goodwill value can exist independently of leasehold rights. The lease and the goodwill are distinct assets, each capable of separate valuation and separate transfer. A lien of a mortgage cannot extend to goodwill that was not expressly embraced in it. And then there's equity protection. Existence and value are questions of fact. Equity protection and existence and value are questions of fact for the jury there. So courts of equity protect goodwill and may properly determine its value in dissolution or equitable distribution proceedings. Both the existence of goodwill and its valuation are questions of fact, not questions of law, to be determined by the trier of fact on the evidence presented. So there you go. Protecting goodwill is through courts of equity. It may properly determine its value, but the existence of goodwill and its valuation are questions of fact to be determined by the trier of fact. They're not questions of law. Interesting on that one as well. Now let's look at some of these cases of goodwill as property. Goodwill is essentially an intangible asset of the business. It's not something you can't touch or feel. but it can be transferred. Western Media versus Merrick, and that's Montana, 1986. And here's another case. Goodwill, when transferred in connection with the business to which it relates, constitutes property. So it's movable, intangible property. Sporley versus Swain, Ninth Circuit, 1972. So the Western Media case and the Spoor letter established the foundational legal premise. Goodwill is property. This characterization carries significant consequences. It can be transferred, encumbered, protected in equity, and its loss gives rise to a cause of action. Sporliter adds an important qualification. The property character of goodwill is realized in the context of a business transfer. It does not float free from the enterprise. So it may exist and it may be accumulating, but it's realized in the context of a business transfer. That's pretty deep there. Let's move along. All right, so we have goodwill's property, some more cases here. Although goodwill of a business is an intangible asset, it cannot be separated
says,
from the
in other words, it's under the table.
What's under the table? If you could elaborate on that one. If you're talking about the previous slide here, goodwill's property.
JOSA figure 5227 says this could be a deep dive in prenuptial agreement.
Oh, goodness. Yeah, we have a whole American jurisprudence on that if we wanted to get into that. If we get more votes on that, I could definitely dive into that one.
Audit term says yeah.
Yeah, definitely. So, anyhow, on this one here, the context.
Matter 5011 says is goodwill a chattel, being that it is not synonymous with real property.
Well, this is an intangible, so it would be a intangible, movable property. All right, let's move along here. Here's another case here. This is also the in Ray Fitch from the Bankruptcy of Southern District of Illinois, 94. Although the goodwill of a business is an intangible asset, it cannot be separated from the tangible assets of a business, and it exists only as an incident of a going business. So if there's no going business, there's no goodwill. So I guess this could have been a bankruptcy where they're being dissolved and there's no going business, and then that valuation's non-existent. And then here we have the BAA case again here. Goodwill is property of an intangible nature, which constitutes a valuable asset of the business of which it is a part. So you can value it. It's a valuable asset. We can put a quantity on there, but it's an intangible nature. It's got its own special characteristics of property, and that's why we're going over this separately, and why we went over the property one first, so we can see where this the nuances come when we're dealing with goodwill as property. And in the Ray Finch case, it introduces a critical practical limit. Goodwill is indissolubly tied to the going business. It cannot be stripped out and sold independently. BAA confirms the positive proposition. Goodwill is a valuable asset of the business. Together, these cases establish the complete picture. Goodwill is a real asset, but one that exists and can be transferred as a part of a going enterprise. So a real asset, I don't think they mean it as in real property here. This is a real asset. Confusing too, and this is why we have to be very precise in the wording in the context as it changes, and the meanings have to be clear. And if you don't clarify it, then the original meaning is the one that will be utilized throughout. So very important to clarify these things. So as we see here, there is that nature of it being a valuable asset. It's intangible, but it cannot be stripped out and sold independently. So it's basically stuck with the tangible assets of a business, even though it's not tangible. All right, let's look at the elements of goodwill, section 5. Goodwill is a constellation of intangible elements. So if property is a bundle of rights, goodwill is a constellation of intangible elements, not a single thing. Courts have identified 6 principles. Elements 1 through 2 concern the conduct and leadership of the enterprise. So this is where we're going to check out their block diagram and their purpose. We have 1, the quality of management. The caliber and judgment of the people who lead the enterprise contributes directly to the reputation that constitutes goodwill. Yep, leadership is from the top down. A business with known, trusted, and effective leadership enjoys a competitive advantage that goodwill captures. Conversely, a change in leadership that erodes customer confidence can diminish goodwill. So a change of management can actually affect the goodwill of a business and lose value if it's a bad change. Then there's the operational efficiency, the ability of the organization to produce and market its goods or services efficiently, signals reliability to customers and the market. A well-run operation builds the kind of reputation for quality, consistency, and responsiveness that translates directly into goodwill and repeat patronage. Because, yes, quality, consistency, and responsiveness. I mean, how many businesses are you going to go to that don't value these types of behaviors for a business? If you don't have any consistency, if you walked into Wendy's every time and it was a different shape or a different weight for the burger, you definitely wouldn't go there anymore. And if they changed your recipe from quality, you wouldn't either. And if you're ignored when you walked in the door for 5-10 minutes, you probably would stop going back there. So indeed, operational efficiency is important too. All right. So these are the elements, first 2 elements of goodwill: quality of management, good leadership, operational efficiency. You have that consistency and the ability to produce things reliably. Then we go on to the nature of competition. The existence and character of competition shapes goodwill because goodwill is fundamentally an advantage over competitors. That's what goodwill is. It's fundamentally an advantage over competitors. So this is a good statement here when you think that you break it down to goodwill is that you will do good, and the ones that aren't will have a disadvantage. So without competition, the concept loses its practical meaning. So it's in a contrast. The degree to which a business outperforms its competitors in attracting and retaining customers is a direct measure of its goodwill. So there we go, attracting and retaining. So you have new customers by attracting new customers, retaining to maintain existing customers, and hopefully you're not losing customers, which is a negative effect on goodwill. So there you go. That's a good way of measuring the nature of competition, and then compare that to competitors. What's their rate of attracting, retention, and loss of customers? And then we have the established client base, the advantages accruing from success, established clients, reliable repeat business, and referral networks. If you're not networking, you're not working. Are central elements of goodwill. This is the accumulated relationship capital of the enterprise, the proven ability to attract and retain customers over time. The accumulated relationship capital. You could even call this social capital, although this is a little bit more specific form of it. But the accumulated relationship capital. And now let's go on to the last 2. Financing and supply relationships. Good relations with sources of financing, with suppliers. This is the other element of your social capital. And with others who favor positively affects the business and with others whose favor positively affects the business are recognized elements of goodwill. So we have good relations with source of financing, suppliers, and others whose favor positively affects the business. Those are all recognized elements of goodwill. A business that reliably pays its obligations and enjoys favored access to capital has a material competitive advantage that goodwill captures. So, friends with the bank. So you could see where this financing and supply relationships could come in. Letters of credit and things like that could evidence this type of thing. And then the last one here, connected tangible assets. Business fixtures, inventory, and other tangible assets that are inseparably connected to the operation may also be embraced within the concept of goodwill, where the physical equipment of a business is integral to its identity and operations. It contributes to the enterprise's overall goodwill. So custom fixtures and jigs, I think, is what they're referring to here, that they might be tangible assets, but they're of a particular style, branding, look, whatever it may be, and that has goodwill attached to it. Again, the goodwill can't be separated from the tangible assets, so if it happens to actually be more or less attached in any other way, it really would be insignificant because it's fundamentally attached. All right. Now let's look at, what happened here? Hang on a second. We got lost here. Bear with me here. Hang on. All right, that's where we left off here. All right, let's look at the cases. What goodwill is not. A newspaper publisher's intangible asset denominated paid subscribers. Intangible asset denominated paid subscribers. The publisher's estimate as of the date of merger of future profits to be derived from identified subscribers was not held to be goodwill because the asset had a limited useful life. Goodwill is indefinite. It can't have an expiration date. And the subscriptions have expiration dates. Okay. And an ascertainable value that could be determined with reasonable accuracy. It was depreciable for federal income tax purposes too. Oh boy, goodwill by contrast remains non-depreciable. The court did not purport to change that fact. That was Newark Morning Ledger Company versus United States, 1993. So Newark Morning Ledger defines the outer boundary of the concept. An asset with a determinable, finite useful life is not goodwill. Goodwill is presumed to endure indefinitely, and it is precisely that presumption of indefinite duration, combined with the difficulty of precise valuation, that renders goodwill non-depreciable. Where an intangible asset can be assigned a finite life and quantified with accuracy, it falls outside the goodwill category. So just because an intangible asset can be assigned, if it's assigned a finite life, it falls outside the goodwill category. Interesting there. So future subscriptions are not goodwill because they expire. And section 6, location as an element of goodwill. And the rule is location is a primary element of a business's goodwill. Location, 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 and provides a saleable element of professional goodwill. Goodwill that attaches to a location rather than to a specific individual survives the professional's death and passes with the premises. Wow, goodwill attaches to a location rather than to a specific individual. A dentist who paid $4,000 to acquire the goodwill of a deceased dentist's practice, the benefit of occupying the prior dentist's premises, received an enforceable property right. Wow. So he wanted to be in the dead dentist's office to fool all the patients to make them think that he's carrying on the goodwill. The goodwill was transferred to him. I'm sure that worked. The distinction between location-based goodwill and person-based goodwill has particular significance in the professional practice context, where the source of the goodwill is the place, the convenience, familiarity, neighborhood. It can be sold, even when the professional who created it dies. Now that's an interesting one there. And then the name and reputation. Ooh, the rule is the presence of goodwill may be evidenced by proof of an ongoing competitive enterprise with continuity of a commercial name and a favorable reputation founded upon the sales of goods or services. The business name itself can carry and transfer the accumulated value of that reputation. A business operating under a well known and trusted name enjoys a head start with potential customers, and that advantage is an element of goodwill. So, how many times have you seen businesses that sell their names? The name and goodwill are legally linked, but can be separately addressed in a transaction. Courts require express transfer of both a trade name and the goodwill associated with it to give the buyer the full benefit of the acquired reputation. Absent contrary evidence, however, both are presumed to pass when the business is transferred. So, unless it's explicitly separated, it's presumed to pass. Wow. So, the goodwill passes with the name unless otherwise evidenced. And competition and goodwill. The rule is, in a legal sense, goodwill means the advantages a business has over its competitors. It has been said that goodwill has value only in the presence of competition. So in a monopoly, I guess goodwill doesn't matter, does it? You see here? Why it's considered valuable property in a competitive free market context. Where there are no competitors, the concept loses its practical meaning. A business with a monopoly has no need for goodwill. Goodwill is the advantage that lets a business attract and retain customers when alternatives exist. The competitive nature of goodwill explains why it is so closely linked to the seller's post-transfer duties. The buyer is paid for a competitive advantage. The law enforces the implied covenant against solicitation to protect that advantage. It also explains why goodwill is less relevant, and less valuable in highly regulated industries where competition is restricted, or where customer choice is driven purely by price rather than established relationship. So you can see the diminishing of goodwill as the nature of the way commerce is done changes, and the regulation effect can diminish goodwill from a business by increasing regulations. So this is a related factor here. As regulation increases, it can systematically remove goodwill and take it so it's not a competitive.
Bill Thimis 4426 says, I wonder if goodwill can apply to an online domain name.
Okay, yeah. Now, well, we get in all these elements that we're looking at here in competition. Is it a competitive advantage? Is there a recognition that you can show attached to that online domain name? So yes, there's a lot of elements to this with intellectual property, and believe me, there's I'm sure plenty of attorneys that are working diligently on these kind of cases right now. But I digress. Good comment though. Let's go on to section 9 here. Who may acquire or possess the goodwill? So the goodwill of a business may not be owned by anyone other than the owner of the business. So it can't be owned. Remember, this is property and is owned by the proprietor, the owner of the business here. The employee limitation. A salaried employee who maintains no ownership interest in a particular place of employment does not possess goodwill, even if that employee has cultivated the client relationships that constitute the business's goodwill. However, goodwill may sometimes attach to an employee who maintains distinctly personal or professional relationships with customers so that the business entity itself possesses little of it. In such cases, the allocation of goodwill is a question of fact. It goes to the jury for that one. That's interesting. So, PA Building Company versus Elwin D. Lieberman, 1996. So, the caution here, though, American jurisprudence giving us a caution. So, let's look at this caution relating to who may acquire or possess goodwill, this property. The seller of corporate stock does not directly own corporate goodwill. That is an asset of the corporation itself, not of its shareholders individually. Both individuals and business entities may accrue goodwill, but which asset it adheres to depends on the nature of the particular business. So anyone can acquire the goodwill, but it adheres to the particular business depending on the nature. So again, question for the jury. Now we get professional goodwill in two views. Whether goodwill exists in a professional practice is among the more contested areas of goodwill law. There's two competing views that have developed. So let's start splitting the hairs here. The personal attachment view. Goodwill in a professional practice attaches solely to the person of the professional, the consequence of the client confidence in that individual's skill. That's the personal attachment view. Because such skills are personal and cannot survive the professional's death, any value inhering in the deceased reputation ceases to exist with them. The business has no goodwill value separate from the professional's person. So as we say here, it's an ongoing enterprise. I guess when the professional dies and that enterprise dies with him, that goodwill attached to, in this view, the personal attachment view. But then there's the broader view. Goodwill exists in a going professional practice, whether or not a sale is contemplated. Elements such as continuity of location, as distinct from personal attributes of the professional, constitute saleable goodwill. That is attached to the place, not the person, and accordingly survives the professional's death. So our caution here, professional goodwill is not the same as earning capacity. It is a distinct asset supplementing earning capacity. That's a matter of marriage of Sedlock in Washington, 1993. So professional goodwill is not the same as earning capacity. It's a distinct asset supplementing the earning capacity. So it's a supplement. It supplies the earning capacity. It is not the same. All right. Now we get to the Fleig factors, age and health. The court applies the Fleig factors in a two-step process. 1, determine whether professional goodwill exists. And then 2, determine its value per accepted accounting methods. Oh boy, we went over this one. Factor 1 is age. The practitioner's age bears on the likely remaining duration of the professional relationship and the business's established clientele. An older practitioner's goodwill, though real, may be of shorter expected duration, a factor that a court will weigh when valuing the asset. So again, it's indefinite. Doesn't mean it's permanent, doesn't mean it's infinite. You just don't know when he's going to die. So it's indefinite. And there's health. The physical condition of the practitioner bears on the expected continuity of the practice. Poor health may shorten the period during which the established client relationships will continue to generate patronage, reducing the present value of the professional goodwill. Wow, so health can degrade the value of professional goodwill. Let's look at some more of these Fleig factors. The earning power and reputation. Factors 3 and 4 address the practitioner's financial history and community standing. So past earnings power. Historical income provides a basis for projecting the economic value of the professional's continued
Matter
reputation.
5011 says, name, image, and likeness can be contracted out may favor the personal attachment view, but in a contrary view, Tom Clancy is dead but still banks on his name without adding new value personally.
Yeah, well, with that kind of property of the name and such, again, when it's in the business context, this is where the value is realized. So without a competitive or business context, then there is no valuation being realized of it. So again, the personal attachment view is good for certain things, but when you're talking about into a celebrity or public figure like that, then things start to get a little bit more complicated. But that said, this is one of the areas that's most complicated in goodwill law anyways. That's why we're really splitting it apart here, and these fleek factors really help. So we see the past earning power is the historical income provides a basis for projecting. See how disconnected, it's not the income itself, it's a basis for projecting the income value of the professional's continued reputation. It has a strong and consistent earnings record, supports the existence of value. So we got to see uh, the more data, the stronger we can make that argument, and we can also be able to demonstrate consistency with a larger data set. Also, the reputation in the community, because standing in the community for judgment, skill, and knowledge. This factor is most directly tied to the expectancy of continued client patronage and is often the primary driver of professional goodwill value. Because when we look for professionals, we like the ones that have good judgment, they have good skill, and of course they have knowledge. And the fleek factors 5 and 6, knowledge and success. Factors 5 and 6, we have knowledge and skill, specialized expertise, and professional competence that clients seek out in return for. Highly specialized knowledge that is not easily replicated elsewhere is a significant and independent source of professional goodwill. So, not easily replicated elsewhere, then that means that I guess you could say it's more restricted availability for people. So that could give it higher value. It might be in more demand, less supply of that specialized knowledge or skill. And then there's the comparative professional success, the practitioner's record of achievement relative to peers in the same field. So if you're the bridge builder that your bridges collapse, you're not going to have that competitive professional success or the comparative professional success and the commensurate goodwill.
Matter 5011 says so the better an athlete performs, the more value the goodwill attached to their nil is worth when they get the tips that value diminishes. Is this a reasonable analogy?
The better an athlete performs, the more value the goodwill attached to their NIL. The abbreviation here, I'm not sure. When they get the tips that value.
Matter 5011 says yes.
That's even harder there. But let's look at this. When they get that value diminishes, they're a reasonable analogy. So if you would look at the track record here, is anything else is business performance, right? So as they're getting a competitive
Matter
advantage.
5011 says name, image, likeness.
Got you. Name, image, likeness. Attach their, yes. Because think about the other things that go that if they have a good performance, then their baseball card or something goes up in value. So that name, image, and likeness will increase. And if they get caught in a scandal, then that goodwill diminishes, right? It's reduced. So yeah, that's exactly how it works in that. And these are things where only because that we're talking competitive athletics in the commercial sense. So as long as it's in that kind of a sense, then I know there was restrictions previously with college athletes not being able to be in that commercial capacity. So a lot of these things wouldn't apply, and I know that's been somewhat overturned with the courts, or I'm not even sure what's happened with that, but I know they've come to some type of resolution at this point. Who's to say where it's going to go from there? So we have here, of course, the record of achievement relative to peers in the same field. So a professional known for superior outcomes enjoys goodwill that translates into a real competitive advantage for the practice. So if he's getting residuals for those baseball cards and t-shirts and all that because of his known for getting superior outcomes, indeed, that's increasing the goodwill value. So let's look at some of these cases, like the matter of marriage of Crosetto. So professional goodwill is determined by considering fleagy factors, which include but are not limited to the practitioner's age, health, past earning power, reputation in the community for judgment, skill, and knowledge, and comparative professional success. Fleet factors for determining professional goodwill are applied in a two-step process. So here's our two steps. Whether a trial court first determines whether goodwill exists. So the trial court, remember that's a fact for the jury to find, or the fact finder if it's not a trial by jury, then determines its value according to the accepted accounting methods. That's from 96, the matter of marriage of Crosetto in Washington. So Crosetto's two-step structure is critical for practitioners. Existence is a threshold question. Value is a separate and subsequent inquiry. So first, existence. If we've established existence, then subsequently we get on to the value. A court that proceeds to valuation without first establishing existence commits a reversible error. Valuation must follow accepted accounting methods, making qualified expert testimony indispensable in professional goodwill disputes. Oh boy, yeah, get those forensic accountants in there. And we get to sections 10 and 11, the transfer of goodwill and the general rules. Since goodwill is property, it is capable of transfer, but it cannot be transferred apart from the business with which it is connected. So transferring the name of an athlete, I guess that's not going to
Matter
happen.
5011 says on that note, how is goodwill valued?
On that note, how is goodwill valued? Oh, as we're seeing here, there's different ways to quantify that. There's a directly quantifiable values of it, and then there's the psychological ones. It's a comparative value. So it's what's the advantage it gives you over competitors, and how can you value that? So again, the formula we saw earlier was to take the value of a business, subtract tangible, intangible assets, inventory, all these things, and then you're left with goodwill. So yeah, it's I guess you could do a deductive process for it. However, it's I guess an accounting art to be able to really value it, and of course it could be in dispute. That's why it has to go through a jury for the final valuation and the existence of it, or the trier of facts, I should say. So let's look at this. Since goodwill is property, it's capable of transfer, but it can't be transferred apart from the business with which it's connected. So that's the inseparability principle. Goodwill adheres to the enterprise. A purported transfer of goodwill alone, disconnected from the business, is legally ineffective. It can only be transferred as part of the ongoing concern to which it belongs. Presumption on full sale and transfer by will. So when the entire assets of a business are sold, there is a presumption that the goodwill passes, even if goodwill is not expressly mentioned in the contract of sale. So unless it's excluded, it's included by presumption. Goodwill is also transmissible by will, passing as a necessary incident to a devise of business property. It is not separable from the other business assets in a testamentary disposition. So when it's being transferred by will, it's not separable from the other business assets. We saw it's attached just like to the tangible assets, but it's intangible. We have transfer by implication. The rule is many courts hold that goodwill passes on the sale of a business in the absence of any expression to the contrary. Goodwill need not be expressly mentioned. So we saw here is presumed. Courts look to the totality of the transaction, the purchase price, what was included, and the evident intent of the parties to determine whether goodwill was meant to pass. There is authority to the contrary, and practitioners should verify the applicable jurisdiction's rule. Well, they said it, not me. And the observation here, a lien of a mortgage cannot extend to goodwill that was ever embraced in it. Goodwill cannot be separately encumbered, just as it cannot be transferred apart from the business. It cannot be encumbered independently either. So you can't lien a lien of mortgage cannot extend to the goodwill. So the practical implication, a secured lender who does not specifically address goodwill in its security documentation may find that the goodwill of the business is not captured by its lien. Wow, that was never embraced it. So here's the, I guess the other aspect of it is that here's the presumption that If goodwill's not mentioned, then it's not captured in the lien. So the lien would have to specifically embrace goodwill. Wow. All right. Then there's a non-competitive covenant, that the presence or absence of a non-competition covenant is a key indicator of whether goodwill was part of a business transaction. But it is not the only indicator, and it is not indispensable. So just a non-competition covenant isn't going to be alone, and it's not the only indicator. So not too much on that. The covenant is evidence of transfer. Goodwill is frequently held to have been sold when the seller agrees to a non-competition provision. The covenant signals that the buyer is paying for and expects to receive the established customer base and the seller's commitment not to undermine it. And transfer without covenant. Although in some states, state law, a covenant not to compete is invalid unless given in connection with a sale of goodwill. Goodwill can be sold without a covenant. The covenant is evidence of the transfer, not a prerequisite for it. So there we go. The clarification just makes things easier, and it gets around these standing presumptions. So here's our practice tip. This should sum it all up from the confusion. Always include an express non-competition covenant in any business sale that includes goodwill. Its absence creates uncertainty.
Joseph figure 5227 says Louisiana law.
Oh goodness, for Louisiana law, yeah, that gets crazy. Especially, I think they have all separate laws for bankruptcy and everything. Some of these states have some crazy laws. All right, so we have here that the absence of an express means written and expressed clearly in the non-competition covenant.
Matter 5011 says Napoleonic Code.
Yep, indeed, that's what it is. All right, covenant. Any business sale includes goodwill. So the covenant, the non-competition covenant, should always be included. Any business sale that includes goodwill. Its absence creates uncertainty about the scope of the transfer and the seller's post-transfer obligations. So again, that uncertainty there is what creates the problems and disputes and might make things contingent upon what was first agreed upon, not what people thought. So the express part of it is all the most important part, and that practice tip here makes all this make sense. Let's move along. So section 12, who may sell goodwill? Well, the general rule is because goodwill may not be owned by anyone other than the owner of the business, only the business owner can sell or transfer it. In the corporate context, there's a split of authority, though. Some cases hold that an individual stockholder may sell corporate goodwill in proportion to their ownership interest. Wow. An early authority holds that only the corporation itself has a saleable interest in its goodwill, and individual shareholders cannot separately convey it. The corporate split reflects a deeper question about the character of corporate assets. Are they owned by the entity alone, or do shareholders have a proportionate beneficial interest they can independently transact upon? Now we get into that corporate law stuff here. But luckily we have our practice tip from American jurisprudence to save the day. In any business acquisition involving a corporation, address explicitly.
Matter 5011 says preferred stock.
Yeah, so we can get into that, but that's, oh boy, hard enough to stick along with these kind of topics here. All right, so in any business acquisition involving a corporation, address explicitly whether goodwill is being sold by the corporation or by the shareholders, and how the purchase price is allocated to avoid ambiguity and adverse tax or legal consequences. So this is essentially your checklist here. So in any business acquisition involving a corporation, address explicitly whether goodwill is being sold by the corporation or the shareholders. So in conveying this business or acquiring this business, it includes the corporation is conveying, or the shareholders are conveying, the goodwill associated with the business. Something of that nature, it seems like here, would be the best practice. And it makes sense to avoid that ambiguity. And we get to the section 13, the contract of sale, what the contract need not do and what courts look for. A contract for the sale of business need not expressly mention goodwill. Goodwill can pass by implication, even if it is not referenced in the written contract of the sale. So it doesn't need to be expressed. In determining, there's that standing presumption that the goodwill is conveyed with the sale. In determining whether goodwill was intended to pass, courts look to three principal factors. One, the size of the purchase. A premium price suggests goodwill was included. Two, express covenants barring competition. A non-compete is strong evidence. And three, what specific assets were conveyed. Customer list, the business name, accounts. The implied transfer doctrine reflects an equitable principle. When a buyer pays a significant premium for a business, the law will not allow the seller to argue after the fact that the goodwill was not included, unless a contract expressly says otherwise. So, in our practice tip, a lot of practice tips from this volume here. Always address goodwill expressly in the contract of sale, specifying whether it is included, the allocated purchase price, and the scope of any non-competition obligation that flows from the transfer, the allocated purchase price of that goodwill. That's interesting there. So this is always express this in a contract of sale. This way it, again, removes that ambiguity. And we have the case here of CNC Service Center. And here's our case, a contract for the sale of a business's assets included in the sale of the business's goods, of the business's goodwill, where the agreement provided for the sale of all assets, including customer lists and the business name. That's the CNC Service Center Incorporated versus CNC Service Center Incorporated. I guess that's the acquisition kept the name and it's just a different business now, and that's Northern District of Illinois in 1990. So here's a commentary. The CNC Service Center is the clearest expression of the implied transfer doctrine applied throughout the commercial infrastructure of the business itself. When the buyer receives the customer list and the business name, as we see here, the two tangible manifestations of the business's goodwill, the law concludes that the goodwill went with them, even if the contract never uses the words goodwill. The converse is equally important. Where a buyer does not receive the name, the customer list, and the accounts, a court may conclude that goodwill did not transfer, even if the physical assets of the business were conveyed. Compare the car dealership situation in section 15. Oh boy. We'll be there shortly. But we got to get through this with the case of Mohawk Maintenance versus Kessler. So although a contract for the sale of an established building maintenance service business did not expressly reflect the transfer of goodwill, a transfer of goodwill was intended in the view of the size of the purchase price and the existence of express covenants barring competition, even though the contract did not expressly reflect a transfer of goodwill. So these cases here, like Mohawk here, really outline the fact that, yeah, you didn't need to put in the contract, but geez, you wouldn't have been in court if you did. All right. And Mohawk Maintenance is the leading case for the proposition that a non-competition covenant combined with a significant purchase price is sufficient to establish an implied transfer of goodwill, even without an express reference to goodwill in the contract. The New York Court of Appeals held that the structure of the deal spoke for itself. Together with the CNC Service Center, Mohawk Maintenance establishes the two paths to implied goodwill transfer: through the commercial infrastructure conveyed, CNC, or through the structure and price of the deal itself, Mohawk. So we get two strong cases there. Again, the practice tip is to express it. And 14, transfer by lease. The rule is that nothing about the nature of goodwill is analytically inconsistent with the notion that the lease of a going business may include a lease of the goodwill connected with it, where a business is leased as a going concern, including its customer relationships, its name, and its operational continuity. The goodwill associated with the business may transfer to the leasee for the duration of the lease. Yeah, I mean, that would be kind of silly not to, but the lease context is less commonly litigated than outright sale, but the principle follows directly from the transfer by implication doctrine. If the lessee acquires the operation of the business in its established form, goodwill goes with it, unless the parties expressly provide otherwise. So again, another practice tip from American jurisprudence. Address goodwill expressly in any lease of an ongoing business, specifying the lessee's rights with respect to customer relationships, the business name, and any post-lease obligations such as restrictions on competition following the lease term. So these things all reflect the transfer of goodwill. Boy. On to name and trademark, which we referred to earlier in the presentation here. So the rule is a trade name and goodwill must be expressly transferred to effect the transfer of those items. So, however, absent contrary evidence, a business's trade name and goodwill are presumed to have passed to the party to whom the business was transferred, even without a formal assignment of the name. But we have a caution. Here's that car dealership case we were being referred to earlier. A car dealership did not acquire a competitor's goodwill where it did not acquire the right to use the business's name, was not furnished with a customer list, did not buy accounts receivable, and did not take up accounts payable. Well, geez, without the commercial infrastructure of the prior business, the name, the customer relationships, the financial continuity, there's no transfer of goodwill. Car dealership example illustrates what goodwill transfer requires, not merely physical assets, but the commercial identity of the enterprise, the name, the customer records, and the financial relationships that constitute the business. All right. And we're on to section 16. The location is the basis for transfer. The rule is goodwill may be transferred on the basis of the benefit of occupying a particular location, where the goodwill of a business is attached to the premises rather than to the person. The purchaser of that location-based location-based goodwill acquires an enforceable right to the benefit of the business's established clientele at that location. So when they get the goodwill, they have the benefit of that established clientele. There are two examples from the cases illustrate a dentist payments of $4,000 for the goodwill of a deceased dentist practice. The benefit of occupying the prior dentist practice was held enforceable. The goodwill was location-based and survived the original dentist's death.
Matter 5011 says sounds like the 2008 GMC case where the blank space or punctuation affected the validity of a legal instrument in bankruptcy.
I'm not familiar with that case, but perhaps. We'll have to, 2008. So we see here with the dead dentist that I guess people really like going to his office, and they probably could care less if it was when it took over the practice. He took the customers, kept the continuity, and the goodwill was location-based and survived, even though the dentist died. And then where 30 to 40% of a buyer's customers were the same people who patronized the seller's barbershop at the same location, this implied location-based goodwill existed and had been transferred without compensation to the prior owner. Yeah, okay, so there it is. There are two examples. Let's move along here. And the seller's duty after transfer, section 17 and 18. So the seller of business and its goodwill has a duty to refrain from soliciting former customers. This duty is not subject to the test of reasonableness and is indefinite in duration. So let's look at the implied covenant in section 17. Even without express non-competition agreement, when the sale of a business includes goodwill, an implied agreement by the seller not to depreciate the value of that goodwill may arise, preventing the seller from taking back that which was purported to be sold. There is authority to the contrary. Practitioners must verify the rule in the applicable jurisdiction. So when you sell that customer list, you're not supposed to be trying to get them back. The representative capacity question. The implied duty may apply to a personal representative or agent who sells a descendant's or principal's business. An administrator who independently solicited the former patrons of his descendant's business for his own benefit was held to have forfeited for the sale, the amount due for the purchase of goodwill. Wow. So there's where the value price of the goodwill comes in handy for that type of remedy there. We have sections 19 and 20, the extent of the seller's rights. The implied duty not to solicit former customers has limits. Two of the most important, competing in a similar business. The sale of a business and its goodwill does not in and of itself preclude the vendor from later competing in a similar business, not even shortly thereafter. The implied duty is narrowly targeted at the solicitation of its former customers. It does not operate as a general covenant not to compete. Where the seller wishes to preclude competition entirely, an express covenant is required. In some states, that's not even easy. So in section 20, use of seller's own name. A trade manufacturer who relinquished goodwill and the right to use his own name to a corporation was later stopped from asserting that right. A seller's right to use his own name may be enjoined, meaning stopped, irrespective of any express covenant not to solicit, to prevent unfair competition. The basis is equity. The buyer paid for the name and the associated goodwill. Boy, so be careful using your name and selling your name. All right. Now we're on the extent of the seller's rights, 21 and 22 sections. Two further dimensions, competing in the same location. The sale of goodwill does not necessarily preclude the vendor from competing in a similar business in the immediate vicinity. However, there is authority to the contrary. There's an area where jurisdiction-specific law controls, and practitioners must verify the rule in the applicable state, as we always say here. And section 22, the solicitation line. The seller will not be permitted to actively solicit the former customers of the sold business. However, a vendor who makes no express covenant may seek trade by any honest method, including public or private advertisement, so long as former customers of the old business are not directly canvassed or personally solicited. So you can't be personally saying like, hey, do you like those burgers from Wendy's? I used to be the owner of Wendy's. Now come over to me. Wasn't that like Papa John's or something, right? But I digress. If the seller does not solicit improperly, this may relieve the buyer of the obligation to pay for the goodwill. If the seller does solicit improperly, this may relieve the buyer of the obligation to pay for the goodwill, so he may get a refund. Yeah. Then we have the involuntary and the voluntary transfer, section 23. The implied duty against solicitation applies only where the transfer of goodwill was voluntary. Where goodwill changes hands through compelled legal process, the analysis is fundamentally different. So with a voluntary transfer where a business and its goodwill are voluntarily sold, the seller is subject to an implied duty not to actively solicit the former customers. You sold the list, stay away. Rationale, the seller chose to sell the goodwill for value. The fairness requires that the buyer receive the benefit of that purchase. That's his property. He gets the benefit. This duty is indefinite in duration and not subject to a reasonableness test. So it's an absolute transfer there. But the involuntary transfer is where goodwill is involuntary transfer, as by sale through insolvency, bankruptcy, or foreclosure. The former owner is not prevented from again conducting a similar business and may even directly solicit the customers of the old business. The compelled nature of the transfer negates the implied covenant. Wow. The distinction turns on consent. Only where the seller voluntarily bargained away the expectancy of customer loyalty is the law prepared to hold the seller to a duty of restraint. So the involuntary transfer, they're not going to be held to that. That's interesting. And the remedies now. Are we still along here to make it to the end? We're pretty close to the end of the presentation. I could split it up, or we could just make it to the end where there is a special treat waiting. I'll wait for some feedback from the chat as we start to read through this section here. So section 24 is on the remedies. So some of these principles where goodwill is wrongfully appropriated to another's use. The wrongful appropriation of that property right is actionable. So proving the loss of goodwill. The Loss of goodwill must be proven by detailed business records before and after.
Bill Thimmeth 4426 says okay to continue.
Okay, excellent. It's not much more to go, but I know this is a lot of material here to cover, but we are going to finish it then. So we're going to make it through the goodwill. So lots of goodwill must be proven, the loss, by detailed business records before and after the wrongful act, as well as through testimony by those with first-hand knowledge of the loss. So testimony, affidavits, things like that, first-hand knowledge. Mere assertion of inability to follow up with clients without corroborating records will not
Matter
establish the loss.
5011 says John Elway sold Elway Autos back in the day, which is now Go Auto. He signed a no-compete agreement lasting a number of years as an example of voluntary transfer.
Okay, excellent. Yes, so there's your voluntary transfer. Again, when it's expressed, it makes it easier. These cases we're reading here are typically where there maybe wasn't something expressed, or if it was expressed, it wasn't followed, and then it was actionable and brought to court. So that's why we're reading those cases there. And again, these practice tips, the things we're learning here, these distinctions and the hair splitting, is to ensure that anytime we come across something like this, it's a very simple practice to be thorough and make sure everything is clearly expressed, not leaving up to uncertainty and ambiguity, which might not be decided to the way it favors our interests. So that said, we look at here the available remedies when it comes to these wrongful appropriations. There's injunction, specific
Matter
performance.
5011 says express yourself.
Yeah, it has to be expressed, not just implied. All right, so we have injunctions, specific performance, and damages. These are the available remedies for the wrongful appropriation of that property right of goodwill. So each remedy serves a distinct purpose. Injunction and specific performance act prospectively to preserve the value of the transferred goodwill. Damages compensate for past harm. So you see here how this works. Past, present, and possibly future. And we have here the injunction, where a defendant has breached its duty against the impairment of goodwill by deliberately soliciting the plaintiff's customers following the sale of a business interest. The plaintiff may be entitled to injunctive relief. An injunction will also issue to restrain the wrongful use of the name of the old business, a distinct but related wrong that directly undermines the value of the transferred goodwill. In either case, the court acts to preserve the value of what the buyer bargained and paid for. Whoa. Injunctive relief is equitable in nature and available where legal damages would be inadequate. Because goodwill is an ongoing asset with continuing commercial value unique to the specific business, the inadequacy of damages is frequently established. So the inadequacy of damages is frequently established. Ongoing asset. Practice tip: where the seller has begun soliciting former customers, move promptly for a temporary restraining order and preliminary injunction. Delay in seeking injunctive relief can undermine the argument that continued breach caused irreparable harm. Ooh, good practice tip there. So he who sleeps on equity is going to miss out. All right, let's move along here. The law rewards those who do not sleep on equity. Something of that nature is one of those maxims. We're on at section 26 with specific performance. Specific performance of a contract may be decreed where the sale of the goodwill of a business is connected with certain premises. So importantly, the right to specific performance is not defeated by a provision in the contract for a penalty in case of its breach. Okay, so just that the inclusion of liquidated damages clause does not remove the court's equitable authority to order specific performance of the goodwill transfer itself. So like injunctive relief, which is restraining, the specific performance is an equitable remedy available where legal damages are inadequate. The unique character of goodwill, tied to a particular business, location, and customer base, means that money damages often cannot fully compensate a buyer who is denied the benefit of that transfer. The coexistence of a penalty clause and the right to specific performance follows from a general equitable principles. The penalty clause addresses the consequences of the breach. It does not eliminate the court's power to order actual performance of the contractual obligation. So specific performance. Some pretty extraordinary remedies here. And then we finally get section 27 with the damages, the evidentiary standard, where plaintiff's loss of customers results from the defendant's solicitation following the sale of a business interest, including goodwill. The plaintiff is entitled to recover damages. 3 evidentiary
Matter 5011 says so damages must be a pecuniary or statutory if injunction and specific performance are equitable.
Well, in cases where damages aren't applicable, and of course it needs to be pecuniary or some type of monetary effect here for damages, where that's not going to solve as a remedy, then you have to look to specific performance and injunction. It would depend on the nature of the whatever the cause here is. So let's look here where the evidentiary standard here, because this is key. Sufficient factual basis. There must be a sufficient and specific factual basis in the record to support the award. So for damages, we need sufficient, specific, factual basis in the record. General allegations of lost business are not enough. The plaintiff must identify specific customers or business lost as a result of the defendant's improper solicitation. That's a high bar there. And 2, best evidence and burden on the claimant. Damages for the loss of goodwill need not be proven with mathematical precision, but the best possible evidence of the loss must be placed before the court, including financial records before and after the breach. So it doesn't need to be proven with mathematical precision, but the best possible evidence. The burden rests on the party claiming goodwill and seeking damages for its loss. Expert testimony is typically required. Forensic accountants have a good day there. So let's move on to the damages and the role of the expert testimony. So here's our practice tip. Damages for goodwill may not be recovered where no expert witness presented evidence on the amount of goodwill lost. Wow, damages for goodwill may not be recovered where no expert witness presented evidence on the amount of goodwill lost. However, opinion evidence is admissible, though not conclusive. A business owner may testify to the value of the business's goodwill based on personal knowledge, familiarity with the business's history, financials, customer base, and competitive position. So our guidance here is always retain and present a qualified expert witness with knowledge of the business's finances and market position when claiming damages for loss of goodwill. Oh boy, so extra cost of litigation there for damages. The gap between lay testimony and expert testimony can mean the difference between a full recovery and a substantially reduced award. So the expert witness is worth his weight in gold here. So the takeaway, the best approach combines, number 1, a thorough financial records before and after the breach. 2, lay testimony from the business owner or knowledgeable insiders. And of course, 3, expert testimony from a forensic accountant or business valuation specialist who applies the recognized components, length of existence, average profits, competitive position, to produce a defensible number. Woo-wee. And section 27, the case Rainbow Travel Service versus Hilton Hotels. Evidence supported the determination that a travel agency sustained $37,500 in damages to its goodwill based upon the failure of a hotel to honor room reservations for a travel group. The travel agency's president testified to the value of the agency's goodwill from its history with the agency and its financial statements and estimated damages at $250,000. Members of the travel group testified to their dissatisfaction. Rainbow Travel demonstrates what works. Lay testimony from the business owner, grounded in institutional knowledge and financial records, combined with customer testimony establishing actual dissatisfaction, The court awarded $37,500, far below the $250,000 claim. The gap between the claimed amount and the award underscores a critical point. Lay opinion evidence is admissible on goodwill value, but is not conclusive. Now, if they had expert testimony grounded in the recognized components of goodwill, the length of existence, average profits, market position, is the more reliable evidentiary path to a full recovery. And look at the difference. So now we get to see between $37,000 and $250,000. How much is that forensics accountant going to cost you? Definitely not that gap. So that's where the expert testimony really comes in handy. Damages for goodwill. Things you learn from American jurisprudence. Now we're on to supervisory goodwill in FIREA. The context in the 1980s to encourage healthy savings institutions to acquire failing ones. Federal regulators entered into supervisory merger contracts with acquiring thrifts. So these are your savings and loans. The contracts permitted the acquirers to count the resulting goodwill. Goodwill's denominated supervisory goodwill as regulatory capital, amortized over to 40 years. Geez, when Congress enacted FIREA in 1989, it disallowed the use of the supervisory goodwill in calculating the new, stricter tangible capital requirements. I think someone in the comments alluded to something of this nature earlier. See if I can find it in here. But yeah, this is definitely something kind of fishy here. Anyhow, you guys know what you put in there. It should resonate. This abruptly terminated the agreements, putting many thrifts out of regulatory compliance and triggering a wave of contract litigation against the United States in the Federal Court of Claims. So the case is a supervisory merger contract, which permitted thrift to count supervisory goodwill towards regulatory capital requirements. This is just out of nowhere, supervisory goodwill. And to apply relaxed capital benchmarks for a 5-year period after merger was breached with enactment of FIREA. So there it is, the First Annapolis Bank Corp versus United States. So that act there, I forget what it stands for there, but anyhow, this one here deals with what we're saying here, the thrifts, and part of that was this denominated supervisory goodwill. So entered into merger contracts with acquiring. These contracts permitted the acquirers to count the resulting goodwill. But once that FIREA, the public law overrode the contract law here of these supervisory merger contracts. So then it was not it was breached with that enactment. So there it is. Boy, the accountants tried a fast one, didn't they? Here's another one, the Fifth Third Bank versus United States. The thrift's successor in interest, so thrift's just a savings and loan, successor in interest prevailed on a claim for expectancy damages, where the breach was the but-for cause of its forced sale of a division, and the damages caused by the sale were foreseeable. But for the breach, which put the thrift out of regulatory capital compliance. See, now they calculated part of their capital to be in compliance was part of that value was that supervisory goodwill. And once the FIREA said that doesn't count, now they're in breach of that. So they're out of regulatory compliance. It would not have been pushed regulators into selling a division to raise tangible capital. Any prudent regulator would have been aware that forcing the thrift to sell could cause such damages. So Fifth Third applies the standard expectancy damages formula. The plaintiff is put in a position where it would have occupied had the contract performed to the specific facts of a supervisory goodwill breach. The key analytical moves are causation.
Matter 5011 says you should do a live stream on the jurisprudence of constitutional law versus judicial review and the Administrative Procedures Act in criminal hearings.
Yeah, we did done live streams on all these here, the American jurisprudence, many editions for the constitutional law, and also the Administrative Procedures Act, which was also recommended by in the chat. and we went ahead and did that one. That was actually an excellent one, and it was actually I used parts from the American jurisprudence from an older edition, and then I brought it up to date with what is it, the Chevron deference and all these changes in there. And it was nice to see how at that time of the writing of the American jurisprudence that had yet to be decided, and they mentioned all the implications of it. And then we went on to the readings of that case and how it's now changed course of administrative oversight and these laws and such. So yes, that's actually a great live stream if you catch that one on the Administrative Procedures Act. Let's see here. Yeah, that's the one. All right, so the case we're seeing here with the Fifth Third Bank illustrates the consequences of the FIREA. The immediate harm was not the disallowance of the goodwill itself, but the downstream regulatory and
Matter
commercial
5011 says, sweet, I'll watch it.
Yeah, thanks. It'll be a great one. And definitely comment on that. It won't be on live, but I'll be viewing the comments if there's anything that looks relevant in there too. So we see the downstream regulatory and commercial consequences that flowed from the resulting capital deficiency. So they get the claim, the thrift successor and interest prevailed on a claim for expectancy damages. We see here in the contracts where perhaps a contract was breached, yet there was that expectancy there. So maybe there wasn't a contract, but there was that expectancy, and the damages were awarded commensurate with that, it seems. So let's look at the measure and the elements of damage, section 28. The general measure is the measure of damages to business property, such as goodwill, is the difference, here it is from the beginning, in value of the property before and after the injury. There's 4 factors here: the length of existence, how long the business operated. Longer track record carries stronger presumption of durable goodwill and makes the damage easier to quantify on the evidence. So again, the longer data set, we can see that it can reveal consistency, whereas a lack of data.
List V 2001 says, Oakland love.
Hey, greetings to you, Less TV. I think we all need to watch less TV, even if we watch none. All right, so again, the length of existence makes it easy to quantify. As evidence, we have average profits. Historic profitability provides the baseline from which the effect of the injury. The reduction in goodwill value is measured. So average profits. Again, length of existence gives us better averages. Business success, overall vitality, the growth trajectory, market position, and competitive standing informs both the existence and present value of the goodwill that was harmed. And of course, continuity under the same name, the likelihood of the business continuing under the same name, a forward-looking factor affecting the present value of the goodwill. So the likelihood of continuing with the same name. So here's our case of Slattery versus the United States, the shareholders of a failed savings and loan, who prevailed in a suit alleging that the government breached a supervisory merger contract permitting supervisory goodwill to be treated as regulatory capital. We're entitled to recover expectancy damages in the form of the value of the thrift on the date of the breach, based on the market capitalization of the institution plus a 50% control premium. It was foreseeable that breach of the goodwill provision would result in significant or total loss. The breach caused the thrift's demise, and the amount of damages was proved with reasonable certainty. So I think this FREA thing here is, they knew it was coming up. Slattery provides the clearest valuation methodology in the supervisory goodwill line. Market capitalization plus a control premium. So that's how they did it. This approach, borrowed from M&A practice, treats the thrift as going concern and adds a premium to a buyer would pay for control of the institution. For practitioners, a 50% control premium is a useful benchmark. The courts will scrutinize the evidentiary basis for any premium claimed. Bring your expert testimony for for a better argument. We have the Home Savings of America versus United States. In calculating damages in a thrift's successful action for breach of supervisory merger contracts, the federal district court did not abuse its discretion by awarding hypothetical replacement costs, the cost of raising capital to replace disallowed supervisory goodwill, discounted by the safe rate of return the thrift's holding company could earn by investing that cash. Geez. Inherent benefits of the cash over intangible capital were accounted for by the discount. How much this really has to do with goodwill when you think about it. This came up with this fiction of supervisory goodwill. It's nonsense. And I mean, the fact they were even able to start up with that had to have Congress enact the FRIA or whatever to keep them from capitalizing on this, using it as a valuation of what you can't cash in that goodwill, the supervisory goodwill. Home Savings established that the replacement cost methodology, what it would cost to raise capital equivalent to the disallowed goodwill.
Matter 5011 says, holy shit, I just realized ARC and Goodwill thrift stores are exactly implicated in this topic. Conspiratorial, they do this stuff right in front of us.
A Goodwill thrift. Yeah, this isn't that kind of thrift. This is savings and loan thrifts, not thrift stores. It's a good one. Yeah, Goodwill thrift. Yeah, it's boy, what a play on words that is, huh? All right, so we have here that the replacement cost methodology, what it would cost to raise capital equivalent to the disallowed goodwill, what they call the supervisory goodwill, is a permissible basis for damages award. The court's requirement that the award be discounted by the safe return of capital is an important moderating principle. Cash is worth more than an intangible, and the damages award must reflect that difference. So we can compare Slattery, the market cap plus a control premium, and the American Federal Reliance damages denied for alternative approaches and limits. So two approaches, two very different outcomes. There you get your distinctions to focus on. But we need to get through here. We're almost at the end here. Section 28, we have the reliance damages and limits. A thrift was precluded from recovering reliance damages based on its claim that it overpaid for 4 thrifts it acquired, where it paid no cash for the acquisitions but assumed the net liabilities of the thrifts. The claim for reliance damages was based on a paper deficit. It was denied. Good. That's American Federal Bank versus United States in 2005. So you can see where these cases, and this is an older edition, I think 2011 of American jurisprudence. So you can only imagine, since the banking crisis, that's all these cases as they pulled through the appellate courts through those years after 2011 that we're not even reading about here. So here's another case. The cost to a thrift of retaining earnings as measured by dividends paid is not separately recoverable as a cost of replacing capital in a suit against the government for breach of a supervisory goodwill contract, where the cost of retaining the earnings is exceeded by the benefits associated with them. Bank of America versus United States, 2006. So the American Federal and the Bank of America define the outer bounds of recovery in supervisory goodwill litigation. Reliance theory has limits on the American Federal, and double counting is barred. So there it is. Boy, they really pulled a good one with that. So our key takeaways: goodwill is the expectancy of continued patronage from established customers. An intangible, self-regenerating property right measured by business value above physical assets. So it's supplementary. The distinctness is it's legally distinct from going concern value and from future earnings. It's an element, it might be an ingredient, but it's different. Each concept serves different purposes in valuation, dissolution, and tax analysis. And transfer, the goodwill is inseparable from the business. It passes by implication. On a full sale, a non-competition covenant is strong, though not required, evidence of a transfer. We have a seller's duty. After voluntary transfer, the seller may not solicit former customers, an implied indefinite duty. The seller may compete generally and advertise, but not directly canvass former clients. The involuntary, it's different. And the remedies, there's injunction, specific performance, and damages, all available. Expert testimony is critical if you want full damage recovery. Damages are measured by the difference in value before and after the injury. All right, and that takes us to the best part of the presentation. It's quiz time. Get to test your knowledge with a fun quiz. So here's where we really get to see how this stuff works. It's not necessarily if you get the question right or wrong. It's when we get to the end and we go through these explanations of why you'll get the strongest insight and really test that working knowledge of what we went through. So here's how we play this game. In the chat, you put the number of the question. This is question 1. It's at the top here, very small. You put in the number of the question and the letter of your answer. If I selected D for question 1, I put in the chat Arabic number 1 followed by letter D delta, and that would be my answer. If I decide I need to change it, I just put that same question number again with my changed answer. The final answer will be tallied up at the end, and we'll test our knowledge and see how we did. Let's get started. Question 1. Which statement gives the classic judicial traditional definition of goodwill? So we're looking for the classical, judicial, traditional definition. The traditional judicial.
Matter 5011 says 1B.
All right, we already got down to 1B, but let me read these out. A is goodwill is an intangible asset of indefinite duration equal to business value above its physical assets. Or B, goodwill is the probability that old customers will resort to the old place. C, goodwill is the ability of a business to generate income without interruption after a change of ownership. Or D, goodwill is the advantage a business has over competitors as a result of being carried on for a period of time. So which is the classic judicial traditional definition? We want that judicial traditional. Is it A, B, C, or D? Now, we had one for B where goodwill is a probability. Or is it A, that goodwill is an intangible asset of indefinite duration equal to business value above
Bill
its
Limit
physical assets?
4426 says 1B.
All right, so we got 1B. We got consensus for B. Let's move on to question 2. A sale contract transfers every asset of a thriving bakery, but never uses the word goodwill. Which statement best describes the legal result? A, goodwill does not transfer. It must be expressly named in the contract of sale. B, goodwill transfers only if a non-competition covenant is included. C, goodwill is presumed to pass, and courts look to purchase price, non-competition covenants, and assets conveyed to confirm it. And D, goodwill transfers automatically in any asset sale and cannot be excluded, even by
Matter
express agreement.
5011 says 2C.
All right, we got 2C.
Bill Limit 4426 says 2C.
All right, so we got 2 for 2C. All right, looks pretty good. Let's move on to the next question. Question 3. After voluntarily selling a business and its goodwill voluntarily with no express non-competition covenant, the seller opens up a competing shop across town and takes out a newspaper ad. Which action, if any, crosses the legal line? If any. A, opening the competing shop because any similar enterprise is barred by the implied duty. B, taking out the newspaper ad because the implied duty bars all forms of post-sale advertising.
Matter 5011 says 3D.
Okay, we get answer for D. Let me read out C. Neither. Without an express covenant, no restriction on the seller exists at all. Or D, personally telephoning each former customer of the sold business to solicit their trade. All right, so D crosses the legal line is what you're saying here. So which action of any? So this is just getting out some of the details after he moved out.
Bill Limit 4426 says 3D.
Yeah, 3D. So that's the one it seems that would be crossing the legal line. But we'll find out soon enough. Question 4. A court is asked to divide professional goodwill in a marital dissolution. Under the Fleeg framework, what is the mandatory sequence? Oh boy, that Fleeg framework. A, first qualifying earning capacity, classify any surplus above market salary as goodwill. B, first apply all 6 Fleeg factors to produce a dollar figure, then determine whether the figure is reasonable. C, first determine whether professional goodwill exists, then, if it does, determine its value by accepted accounting methods. Or is it D, first obtain expert testimony on value, then determine whether goodwill is a marital asset subject to distribution? So the fleek, think about it, the order to do things, right? What is the mandatory sequence
Matter
using
5011 says 4D.
4D? Okay, to first obtain expert testimony. Remember, the fleek was to have a sequence for doing things. There's something first to do, and then if that is there, then you go to the next thing. But that's the fleek factors. Any other takers for question 4 before we go on to the answers? Going once, going twice, going 3 times. We're on to the answer key. All right, so let's look at the answers here. For question 1,
Bill Limit 4426 says 3B. Matter 5011 says maybe 4B, but then is expert testimony required?
Well, we're going to get to 4B in just a moment. So let's start with question 1. The correct answer was B. The classic traditional method is the probability that old customers will resort to the old place. So that's...
Bill Limit 4426 says 4B rather.
Yes, indeed. Well, it's still not the right answer here, but that's okay because what we're getting here is on question 1. So we all pretty much got question 1 correct. Yeah, the probability that old customers will resort to the old place is pretty much the traditional definition of goodwill. Now, on question 2, correct answer was C. Goodwill is presumed to pass. Courts look to price, non-competition, and assets conveyed. So I think on 2, we got that one correct as well. And yeah, sections 10 through 13 with the Mohawk Maintenance Corporation versus Kessler, that's a price and non-compete. And the CNC Service Center with the assets conveyed when they took the name and everything. A is wrong because the express mention is not required. B is wrong because a non-compete is evidence, not a prerequisite. And D overstates. The party can exclude goodwill by express agreement. And as of course we saw here with the question 1 that the probability old customers return, that's the Scraback versus Scraback. And A is the section 4 surplus value measure. So these other answers were wrong. The B was the only one that's correct. All right, now we're on to question 3, D. Which post-sale action crosses the implied duty line without an express covenant? Is D, personally telephoning each former customer of the sold business to solicit their trade. Yeah, that's a pretty dirty trick there. Indeed, 3D is the correct answer here because that's 19 and 22 sections. The implied duty targets direct personal solicitation of former customers, nothing more. A is wrong. Section 19 permits competing in similar businesses. B is wrong because Section 22 permits general advertising. C is wrong because the implied covenant exists even without the express non-compete. But that personally telephoning really crossed the line. The former customers, he sold that list. That list is for the other to enjoy and not for him to use. Remember that part of the property rights is the exclusion of others using the benefits of that property. That customer list is now the property of the new buyer. The seller cannot be enjoying the benefit of that property right. So that's definitely crossing the legal line. All right, let's get on to question 4. The correct for the mandatory fleek sequence in a professional goodwill dissolution. Correct answer is C, because remember it's just a sequence. First, we need to determine whether the professional goodwill even exists. Then, if it does, determine its value by the accepted accounting methods. This is where, if you want to get the full value, let's see here. We had some good comment here. Let's see here. Where was it? Yeah, we have here. I'll just read from the my explanation here. Is in the matter of marriage of Crosetto, the two-step mandatory is mandatory. The existence is a threshold. First, we get the threshold established. Was there goodwill? Does it exist? And then next, after establishing the existence, then you figure out the valuation of it. So there's no stepping up to valuation with expert witnesses coming up with the value. Remember, the expert witnesses to make sure you get the full value of damages. So without having that threshold of existence, there's no reason to have an expert witness. So without first establishing the existence, that's what's necessary. Then after that, the valuation can be done. So that's the problem why the other answers aren't correct. A conflates the goodwill with earning capacity. B and D invert or conflate the steps. So as we see here, C, it's first determine whether the goodwill exists. Then if it does, determine its value. And that's the Fleeg sequence. And then there's other factors in there, but that's essentially the main takeaway from that. And then, of course, that valuation, it sure does benefit to have that expert witness. So with that said, I think it was a pretty challenging test here. It has been a very challenging episode on goodwill. This is just one of the forms of property here that we've been covering, but it really deserved its own episode here, I believe, because indeed, actually, it's a 2008 edition of American Jurisprudence. Now I remember from the sign on the wall here. But indeed, this is a very nuanced area of property rights.
Matter 5011 says complicated and precisely you.
Yeah, indeed. But this is where you see these things are affect us daily because, again, having repeat customers, having be able to plan things like contracting is the essence of all that. And if people aren't abiding by the laws of the contract, then the future planning and the good faith disappears. And part of that is the goodwill that's actually externally provided, but internally retained and attached to the property itself, so of the business. So in a very complex way, the intangible property that's attached to the tangible assets. Very nuanced and very precise. So I thank you all for attending here. It has been quite a enlightening type of presentation because I learned a few things along the way. I hope you did too, and I surely hope to see you all on the next one. Peace out.
Bill Thimmett 4426 says take care all. The tribe says, hit the like. Matter 5011 says gracias buenas noches.